CPI data just dropped, but why does everyone in crypto suddenly care? What's the link between this random economic report and the price of Bitcoin? Let's break it down. CPI stands for the Consumer Price Index. Think of it as the official inflation meter for the economy. It tracks the average change in prices that you and I pay for everyday things, like groceries, gas for your car, and rent. It tells us how quickly the cost of living is going up. So when you hear that CPI is high, it means inflation is running hot. Prices are rising faster than expected, and your dollar just doesn't stretch as far as it used to. This is where it gets interesting for crypto. When inflation is high, it spooks central banks like the Federal Reserve in the US. Their main job is to keep prices stable. To fight rising inflation, their primary tool is raising interest rates. By making it more expensive to borrow money, they hope to cool down the economy and bring prices back under control. So, a high CPI number usually signals that interest rates will stay higher for longer. Now, why does this matter for your crypto portfolio? Higher interest rates act like gravity on financial markets. When borrowing money becomes more expensive, companies and investors become more cautious. It makes safer, interest-bearing assets like government bonds more attractive because they offer a guaranteed return with less risk. At the same time, the US dollar tends to get stronger because higher rates attract foreign investment. This creates a tough environment for what are known as risk assets. These are investments like tech stocks and, you guessed it, cryptocurrency. When money is expensive and safe returns are easy to find, investors are less likely to gamble on more volatile assets. They sell off their riskier holdings, and that's why you often see Bitcoin and other cryptocurrencies take a hit when interest rates are high or expected to rise. A strong dollar often means a weak crypto market. But what about the flip side? When the CPI report shows that inflation is cooling down, the market breathes a sigh of relief. A low CPI number suggests that the central bank's previous rate hikes are working and that they might soon be able to pause or even start cutting interest rates. This is the signal traders have been waiting for. Lower interest rates mean cheaper money. It becomes easier for businesses to grow and for investors to borrow. This cheaper money environment encourages more risk-taking. Investors move away from the safety of bonds and start looking for higher returns in assets like stocks and crypto. Suddenly, Bitcoin looks a lot more attractive. This expectation of future rate cuts is what often fuels a strong rally in the crypto market. So a low CPI can be very bullish for Bitcoin. So every time a new CPI report is released, it's not just a bunch of boring numbers. It's a crucial pulse check for the entire global economy, and it gives us a huge clue about the direction of money flow. It tells us whether the financial environment is becoming more friendly or more hostile to risk assets like Bitcoin. Understanding this connection is key to not getting caught off guard by sudden market movements. It's about reading the mood of global money. If you want to keep getting these no-fluff breakdowns of what's actually moving the markets, make sure to subscribe and hit that notification bell. Thanks for watching, and I'll see you in the next video.